All right. Just a brief update on the security analysis. I went back through and apparently I had deleted the section that I wanted you all to see about coming up with a list of comparables. So comparables, competitors, however you want to reference them. But basically, these are the firms that you believe are the closest matches to SFM. And you're going to use those as a benchmark against which you compare SFM's performance on a variety of metrics. And we've got these ratios, 5 different categories that look at efficiency, profitability, leverage, things of that nature, coverage, those things. So, and those are all in the additional notes in the modules, in the module section of Canvas under security analysis. So I've uploaded the updated assignment, and that does include the discussion about comparables. Let me switch over to that right now. And hang on just one second. Get out of the way. All right, so here is the addition right here that I've made. So select the comparable firms, a minimum of 4. You're certainly welcome to go with more. It's not all that much work and probably gives you a better outcome. But what I'm looking for are those firms that you believe are most comparable, closest matches to SFM, recognizing that you're not going to get a perfect match by any stretch, especially for a company like this. But always go back to that housing example, where we're looking at comparable homes. If you're trying to value a 2-story, 3-bedroom, 2-bath, 1-car garage detached home, you're looking for other homes that match all of those key characteristics. Now, can you find a home that matches exactly all of those? No, probably not, but you might find one that, has a 2-car detached garage, and you make an adjustment to it for that. You recognize that. The parallel works in this world when we're talking about companies. So dig through there. The Bloomberg will give you a good start on here's who we, Bloomberg, think are the industry comparables. So they'll give you a whole list of firms in that industry. Recognize, though, that all of these industries, particularly if you're looking at the typical industry categorization, they're self-categorized. So firms will self-identify as in a particular industry. They'll have a primary, and then there'll be some secondary industries that they identify in. So this is at the firm's decision. You're not constrained to that. If you think that a company outside of that particular industry is a better match, use it. But describe for me why you're picking each company. And then you're going to gather the ratio data for all of those companies as well. And you're probably going to want to dig into the company a little bit too and see what makes it tick. What's making the ROE what it is before you actually come up with a final decision on it. Another source for comparables is to look at other analyst reports. Again, Bloomberg is a great source for that. So come up with that list, provide me with a paragraph describing why you picked each of those firms, and then download all of their ratios. And you're going to use that in your graph, in your graphs down here. So when you plot all of the ratios, you're going to have the company. By the way, this is the level of the ratio on the y-axis, time on the x-axis, and you're going to have a plot that shows SFM, and you're going to have another line that shows the average of the comparables or the industry, your industry, right? Another thing that I point out in here is you have to be very careful, especially when you have a relatively small group of comparables, and 4 or 5 is relatively small. And any one comparable might have a ratio that's way out of the norm, way off the charts, an outlier, as we call them. And you don't want that to drive the mean. So if you're looking at my point here is you want to look at these ratios for each of the comparables as well as SFM and make sure that something weird didn't happen in a particular year that threw the ratio out of line. You're going to have to make a decision. Do I leave that out? It's always a difficult decision when we're looking at data. You never want to just arbitrarily throw data away. But if it's bad coding or bad data, then you should get it out. But you do want to investigate. So if you're looking at ROEs and you see a negative value or something like that, or you're looking at PEs and you see a PE of 300. Those are outliers. They're going to drive your average, and then it's going to make no sense when you try to interpret SFM versus the average of your comparables. So spend some time on this. Don't just take it as, oh, this is another assignment. No, this is actually what many of you will probably end up doing. So hopefully it'll be interesting. But I just wanted to point out some of these potential problems that you run into. So I've uploaded the new assignment. It includes that. And then I've also created over here under assignments a new group of assignments, and that is right here. So now you'll have you'll go into the first deliverable here, and there's basically this is just a repetition of what's in the PDF file, and then you can upload whatever it is you need to upload. You'll probably at the very minimum have a Word file that has the links and may have this paragraph on each of the comparables, maybe some other discussion that you might want to add. I would also recommend that you start off, get that title page in there, get a table of contents in there. If you're a more of a Power Word user, you know that you can tag for the table of contents. So, set that up so that it's all ready to go as you add additional material to the Word doc. And then more than likely, you're also going to need to upload a spreadsheet that has not only the financial data, the 5 years of income, balance sheet, and statement of cash flows, as well as the ratios and the plots that you're going to do. Try to format them nicely so that, what I typically do in terms of organizing my spreadsheet, especially when I'm comparing the SFM to the comparables, I put SFM on the first tab, and then I make 4 additional tabs. Each of those contains the set of ratios for the comparable firms. And make sure that when I copy and paste or whatever I've downloaded out of Bloomberg, that I line it up exactly in the cell that SFM's ratios are lined up in. So if you download all of these ratios out of a single source, they're all going to come out, here's the profitability ratios, and they're all starting off with operating margin, net income ratio to equity, so ROE, ROA, that sort of thing. They're all going to be in the same order, and then you've got your efficiency ratios all in the same order. So it becomes very easy to create an average, right? So you've got your 5 years of SFM on the front page, on the first tab, and then you've got the other firms behind that. They're all lined up. Then all you have to do is go to the right of SFM and do an equals average, open parens, and then go to each of the ratios on the other 4 tabs, click those in, interspaced by a comma, hit the enter key, then you've got the average for one particular ratio. Then you just copy down, copy right, boom, you're done. You've got all of the averages. And then you've got the SFM on one side, the average for the comparables on the other, and it becomes very easy to create your plots. Literally, when I've got, from start to finish, gathering the data, putting it in the spreadsheet, organizing it, making the plots, when you get fast at it, you can do that in under 30 minutes. More like 15 minutes, really. Now you guys, this may be the first round for you, but you get the idea. Kind of do this in an orderly fashion so that it doesn't eat up a lot of time. While we have to do some things that are just mechanical, that's not where the value added is, right? So get the mechanical done as quickly as possible, then start looking through and say, oh, wait a minute, I've got an outlier here. I need to make a decision on, was this just a coding error? Is it something I want to throw away? Or maybe that firm really outperformed in a particular year or something of that nature. But and then you'll end up with your final version of the graphs once you've made those decisions. So the rest of it, any questions so far? Have you all gotten started on it, I hope? I haven't heard anything from any of the teams yet. I'm a little worried. Everybody ready? All right. All right. Any other questions before we get back into talking about bonds? All right. I don't see anything, so let me get over to the PowerPoints. Okay, so we were right about here. we talked about yield to call versus yield to maturity, and that a callable bond, that was the more relevant yield that we'd be looking for. And then we stopped right here talking about interest rate risk. Interest rate risk is really, really important here. We run into this constantly. So we're talking about a couple of different types of risk, and we'll define those as we go through the rest of the slides in this chapter. But let me just give you the brief preview. The primary types of risk we're talking about are reinvestment risk and price risk, and they're certainly related issues. But just to start thinking about this in an overall sense, interest rate risk causes us to never, ever end up getting what we calculate as the yield to maturity or the yield to call. And that's because interest rates move around, and we have implied in our pricing formulas that interest rates are constant. And since we know that that's not true, that yield to maturity or that yield to call estimate that we make is never going to actually come out as the same as the realized yield. That is, once I've held the bond to maturity, I look back and I calculate what was my annual yield on this particular instrument. It's going to be very different. We can see that as yields change, the price of the bond changes dramatically. And this is, here we're just comparing a 5-year against a 20-year bond. And you can see that definitely the 5-year bond is less risky in terms of price movements. So here we can tell that we're starting off with two bonds that have a coupon rate of 8, and they are priced at $1,000 per bond. Now, if yields change, in other words, if the market rate of interest changes, as it goes down, remember that inverse relation between yield and price. As yield goes down, price goes up. And in terms of the 5-year maturity, it goes up by a little bit, and the 20-year goes up by a little bit more. And the further we keep moving down here, the further those lines deviate from one another. So the 20-year is much more volatile, has much more price risk for a given level of change in yield. And the reverse over here, as yield goes up, price starts to drop. And again, notice that the 5-year has a little bit of a decline in price, whereas the 20-year has even more. And again, as we go out here, we see that they deviate from one another. But notice also that this deviation, if we're over here, let's pick 4 percentage points either direction. So we're right here, and 4 percentage points here. Notice how that difference in pricing it changes as we go from increases in yield to decreases in yield. So these lines do not have a constant slope to them. The slope is continually changing. Now, I'm sure that you all had Math 130, right? Probably wondering about, will I ever use calculus? And bonds and fixed income is one spot where calculus comes in. Obviously, we've talked about it a little bit in terms of in terms of integrals when we try to value, say, an option. We're going to talk more about that at the end of the semester. But in this case, we're not talking about integrals. We're actually talking about derivatives. And what you're going to find is that the first and the second derivative of this price-yield relation is extremely important. And in fact, the duration of a bond is actually the first derivative of the price-yield function evaluated at a particular yield. And the rate at which it changes is the second derivative, obviously, and that's called convexity. So we've got two terms that are really, really critical to understanding fixed income, duration and convexity, and those are simply the first and the second derivatives of the price-yield function. So keep that in mind, too, as we're looking through all of this. You all remember derivatives, right? I'm not going to ask you to calculate anybody, but I think the intuition is really important to get to help us to understand this. Now, some of Malkiels came up with a number of theorems about how prices and yields relate to one another. This one, you all know this one, right? Bond prices and bond yields are inversely related to one another, or in other words, they move in opposite directions. So when the yield goes up, the price goes down. When the yield goes down, the price goes up, and vice versa. For a given change in yield to maturity, the longer term to maturity of the bond, the greater the magnitude of the change in the bond's price. So this second theorem that Malkiel posed actually is what we were just observing a minute ago on this graph. All right, so for a given change, so we go from 6 to 4, the change in price of the 5-year is just modest, whereas the change in the price of the 20-year is quite a bit greater. So that's Malkiel's second theorem. And there are 3 more. For a given change in yield to maturity, the size of the change in the bond's price increases at a diminishing rate as the bond's term to maturity lengthens. The change in the bond's price increases at a diminishing rate. So if we were to have 3 or 4 different maturities plotted in there, we would see the slopes continuing to increase, but increasing at a diminishing rate. So that change from 5 to 10 is going to be a bigger change in slope than from 10 to 15. Okay? Then number 4, for a given change in yield, the resulting percentage change in the bond's price is inversely related to the bond's coupon. So this is the difference between the first theorem and this one, is that here we're talking about coupon rates, and that the percentage change in the bond's price is inversely related to the coupon rate. So the higher the coupon rate, the lower the change in the bond's price. I think a rough intuition to have on that one is that, and this is also related to duration, the quicker I get my money back, the less a change in interest rate is going to affect me. So when I have a really high coupon rate, I'm getting a lot of money back early on. And that's not as influenced by compounding when I have a high yield. So you can, like I say, there's a bit of intuition there. And for a given absolute change in yield, the magnitude of the price increase caused by the decrease in yield, that's that inverse relation, is greater than the price decrease caused by an increase in yield. All right, what's that actually mean? Let's go back to this graph. This graph really helps us out there, right? That's what we were just seeing, where when we go 4 percentage points above the coupon rate and 4 below, we see this difference is greater here than it is over here. I guess I should change the color of my pencil. So the difference here is greater than the difference here. That's what the fifth theorem says. So the slope is, think of it as that slope is, oops, how am I going to do that? I have to invert my, I'm looking at my screen and it's hard to, yeah. So the slope is changing, it's shifting as we move out into higher yields. It's flattening out. That's the fifth theorem. So those are helpful things to, at some point, if you get into fixed income, you're going to want to commit these to memory, but by the time you get to that point, they'll already be embedded because you're dealing with these things all the time. But for right now, you know, if it takes memorization, it takes memorization. Here's, I just plotted this out to give you some idea of how some of the options might change that price relation between price and yield. So when we have a callable bond, so here's the normal yield curve, yield to price relation. And now when we add a callable option to it, it does this. So instead of that green line, our price to yield function looks like this. And also, if we add to it a potable feature, it truncates it on that side. And then obviously, if we have both, you know, we get this and this and that. So hopefully that again helps you to get some intuition behind how these things add or subtract from your valuations and alter the price yield relation. Think about this callable bond. Why is it that we flatten things out here? Why doesn't the function just continue on up this way? Well, as yield drops, and remember we're talking about market rate of interest, as yield in the marketplace drops, what's the company decide to do? They're going to call the bond because they can reissue a new bond at a much lower rate. And so by virtue of that, we are going to get closed out, if you will. They're going to give us the face value of the bond and call it back in. There may be a premium that we get on it, and the premium is going to cause this part of the curve to either be up here or down here, depending upon how much premium we get. Sorry, I made a mess of this graph, but you get the idea. The reverse on the puttable, we're able to put the bond to the company if interest rates go up. If yield goes up, why do we do that? Because the price of our bond is dropping precipitously, and we can put it to the firm at the face value. So that's why we've got a truncation here that we see for the puttable bonds. And this just puts some numbers on basically what we've been looking at in the graph, so I'm not going to really spend any time on that. All right, now so what we have is that the change in the bond price is approximately equal to negative times the negative duration times the change in yield to maturity divided by 1 plus the yield to maturity divided by 2. And again, this is assuming a semi-annual bond. And let me get back to you all. All right. So this is known as either just duration or to recognize the person who came up with this relation, Macaulay, back in the early part of the 20th century, I believe 1930s. So either one, Macaulay's duration or just simply duration, mean this formula. All right. So that formula isn't particularly informative to us, really. So, boy, I don't know why this didn't save. I guess some of these did work. Let me just go to the blackboard here. The way I like to think about duration hopefully will provide a lot more intuition for you. And duration is, in words, it's a value-weighted time to maturity. And the value-weighting system that we use is how much of our money are we getting back in present value terms with each cash flow. So we can think about it using the summation. And we're going to sum from t equals 1 to the time of maturity, capital T. And then what we're going to do is we're going to take the cash flow at time t. So in most cases, this is simply the interest payment. And let's just talk in annual terms. Let's not do a semi-annual yet. So each period in this example, I mean, you could use it as semi-annual or quarterly, but let's assume that each period is a year. So this CF sub t, the first time I go through this summation is t is equal to 1. So that's the interest payment that I'm going to get in 1 year. And what I'm going to do is I'm going to discount that interest payment back to time 0. And I do that by dividing by 1 plus, and I'm going to call it YTM just to try to stay consistent with your book's notation. And I'm going to raise that to the tth period. Okay? So that gives me the discounted value of next year's coupon payment. Then I'm going to take that and divide that whole thing by the price of my bond. Okay, so let's go down here, just revisit the price formula as well, and we're going to look at it in the same framework. So, and remember, this capital sigma simply means sum up all of the things that I have from 1 to cap t. So really what I have, a capital sigma, really that means I've got some value here for period 1, and I'm going to add that to some value for period 2, add that to some value for period 3, all the way up to period t, however many periods we have, just as a reminder. So you'll see this summation used in a lot of areas. All right, so how do we price the bond? Well, we take the cash flows in any given period and we discount them by the yield, right? Raised to the tth power. So our pricing formula is the sum of all these cash flows. So let me rewrite this. This is cash flow 1 discounted by 1 plus, and I'm just going to shorten that up to y, that's YTM, raised to the first, and then cash flow 2 discounted by 1 plus y raised to the second, and so on out to cash flow t discounted by 1 plus y raised to the tth power. I add all that up, and that's the price of my bond. So I'm taking one of these and I'm dividing, so that's this, right? And I'm dividing it by the sum of all of these discounted cash flows. What that is going to give me is what percent is that particular cash flow relative to all of the cash flows that I'm going to have in this bond. So this ratio right here, I'm going to clean this up a little bit. Get rid of that mess. This ratio is simply giving me a percent of the overall cash flows on a discounted basis. So these are all brought back to times 0. So they're all in present value terms. So there's my percentage piece. Now all I have, oh, sorry, go ahead, Brett.
Sorry to interrupt. So
No, please do.
in the denominator, that's always going to be a decimal? Or is the entire thing a percent?
It's set up in decimal form right now. I mean, yeah, we'd want to keep it in decimal. So if this turns out to be 5%, it'd be 0.05.
In the denominator?
No. Sorry, let me separate that out because I'll change colors. So this thing right here is the percent that cash flow makes of the overall cash flows. Yeah. Sorry.
Thank you.
Yeah, no, this is actually, this would be price just in dollars, effectively, but present value dollars.
Okay.
Good question, because this can get confusing. Okay, so then all we have to do from there, we just multiply that by t. So if it's the first period, the first year, that's a 1. Second year, that's a 2. So I go 0.05 times 1 is 0.05. So now if I wanted to write that in up here, I would have, this is 0.05. Plus, then I do the same thing except I increment to 2 years. Now, obviously, the cash flow in all of the years up until maturity date, those are going to be the same because we're talking about coupons here. So whatever the coupon rate is times the face value, that's our cash flow. So those are going to be the same, but we're going to discount them for an additional year. So these percentages are actually going to drop as we go through. But so this first one, the period 1 percentage was, let's call it 0.05. That was 5%. Period 2 is actually going to be less than that. Just to keep the math simple, let me just say it was 0.045, so 4.5% of the cash flow. Except that in this case, instead of multiplying by 1 like I did up here, I multiply by 2, and so my next number that I put up here is 0.09. And then period 3, the percent that third coupon in present value terms makes of all of the coupons and the face value that I get back at the end. Let's say it drops to 4%, but 4% times 3. So then I put in, add 0.12. And I keep doing that. Now, obviously, this last one, because it includes the return of our principal, the face value of our bond, that's always going to be a big percentage. And we're, so that's going to be 60, 70, 80%, depending upon what our coupon rate is and what our yield is. But that's always going to be a large percentage, and we're going to multiply that by the time to maturity. So whatever capital T is, if it's 10 years, we multiply that by 10. We add that whole thing up, and that is our Macaulay duration. So I think, let me illustrate that a little bit further with a spreadsheet. Okay, so here what I have is I've got a bond with a face value, and face value is 1,000. Okay, and right now I have a coupon rate of 5%, and I'm setting the market rate at 5% as well at the moment. And so this column C right up here, oops, didn't mean to actually highlight that. Column C are our cash flows. So here's my $50 coupon, and I keep that going for 10 years. And then this last payment is my principal repayment plus the last coupon payment. So that's all in dollar terms and actual dollars. This next column, I've actually calculated the discounted value of that. And since my market rate and my coupon rate are identical, obviously the price of this bond is going to equal the face value of the bond. So you can pretend that we issued this at par, and we just issued it. And the interest rates have not changed since we set our coupon rate. So you'll notice that the present value of these cash flows decreases as we go down the line. And then, of course, that's where we see that big present value because of the additional principal repayment at that time. And we talked about this a little bit in the last class, but I want to go back over this again. I can get the same exact numbers. Now, column D is what you all are familiar with. That's kind of what you were taught in 312, right? Column E, I don't know if you looked at it this way in 312, but I can get the exact same numbers by doing something slightly differently. When I say grossed up, what I mean is that I'm taking this coupon and I am reinvesting it from the time I receive it all the way down to maturity. And you'll see the logic in this once we talk about immunization and duration matching. But I just want to show you right now and reemphasize that I get the same exact answer. This is the same process. So the value of that $50 coupon that I receive 1 year from now, when I hold that reinvested at my market rate, the value of that coupon is $77.57. But remember, I'm putting all of those coupons out here to year 10. So I'm moving them. If I were to make a timeline here, here's my $50. Is that little sparkle thing too distracting, or does that help? Okay. So here's year 10. Here's year 0. Normally what we do is we move things back to year 0, right? And we add them up. That's this right here. But what I'm doing in column E is I'm moving it out 10 years out here to year 10. I'm grossing it up. So I'm taking $50 times 1 plus 0.05, which is my market yield, raised to the 9th power. And that gives me $77.57. And then the next coupon I take and I reinvest that way. And I'm assuming I'm going to get the market yield all those 9 years, all 8 years, all 7 years. When I add all of those up, I end up with $1,628.89 for the value of the bond at time T, capital T, year, in this case, year 10. That's the maturity. Now, when I discount all of that back, so I'm taking this lump sum and I'm just discounting it back to time 0. I'm using that same market yield, that same 5%. So this is 1628.89 divided by 1 plus 0.05 raised to the 10th power. When I move that back, I get the exact same number. You might say, well, you've added one more step. What's the point? The point is that part of the idea behind duration matching and immunization is that, and I think I can get this to work. Oopsie daisy. Nah, come on over here. Go back there. There we go. So I've got built into my equation here a little bit of a rate change. So instead of 5%, what I'm going to do is I'm going to change the rate. I'm going to increase the rate from 5% up to, let's say, 5.2%. So let me enter in 5.2. And nope. 5.2. There we go. I think that's going to work. There we go. Oh, whoa. Hang on. Oh, my bad. I did it wrong. So actually the way I've got this built, this is just the marginal change. So the market rate that we started with is 5%, and you still see that in column E here, and that hasn't changed. But I've added to that this extra 20 basis points, 0.2%, and that's represented over here in column F. Okay. And let's see if I can clear off some of this. Okay. So where do we go from here? So column F, we see a couple of things. One is that if we compare prices, we'll see that the price of this bond has dropped. Yield went up, price dropped. Okay, that makes sense, right? The other thing, though, that we see that is a little less obvious probably, and that is that when we look at the reinvested cash flows, the reinvested coupons, we notice that the value of that has gone up rather than down. So I'm getting more out of those reinvested coupons because I'm investing them in a environment that has 20 additional basis points. So I'm reinvesting that $50 back here instead of at 5%, where the grossed up value is worth $77.57. I'm investing at 5.2%, so the grossed up value is worth $78.91. So I'm getting more on my reinvested coupons, even though my bond price has decreased. And you see that this goes the same way all the way down here. And of course, the greater the change in the yield, the higher it goes, the more I get on the reinvested coupons, and the lower the price goes. So you see we've got these countervailing forces going on here, right? I get more reinvested coupon yield, and I get a lower price. Now, if yield were to go down, if this were a negative 2%, and let's see if I can get that, negative 0.2, we would see the exact opposite thing happen. Price goes up to 1,015.59, and yet what we get on our reinvested coupons decreases. So by about $1.25-ish, 27, something like that. So again, countervailing forces. The whole point of this is that, and again, this is more of an intuition. What we do when we pick duration, by the way, I've also calculated duration over here. And the duration of this particular bond at 5% market yield and a 5% coupon, the duration on this bond is 8.107 years. All right. So the neat thing about these countervailing forces, price dropping and reinvested coupons increasing or vice versa, the neat thing about that is that if I have a target date that is exactly 8.1 years away, and I buy this bond, I will have a fairly good chance of having a known amount of money on or about the end of year 8. So if I need $1,000, I can calculate and I'm earning 5% on that. I can calculate back to today how much I need to invest to have $1,000 in 8 years, even if interest rates go up or down over that period of time. And I know they are. Remember what we were saying earlier about the YTM never quite equaling the realized yield? That's if I don't use this idea of duration. But if I use this idea of duration, then I'm able to actually, with some certainty, say, if I need that $1,000 in 8 years, I pick this bond, which has a duration of 8 years. And even if rates go up or down by 10, 20, 30 basis points, I'm still going to have pretty close to my $1,000. It's not always an exact match. And by the way, duration keeps shifting as we move through time. So there's actually what we'll talk about at the end of this chapter and what you've read about already is a concept called dynamic duration matching. And that means that each time that goes by as yields continue to change, as I get closer to maturity, the duration of my bond is going to shift on me and I have to keep updating it. I have to keep making some minor changes to my portfolio as I go. But the basic premise is this, that what I lose in the one side, I make up in the other. And if I have a target date equal to the duration date, those two countervailing cash flows more or less offset each other. That's a really, really helpful thing if you're a pension manager, right? And you know you need $1,000 at this point to pay your pensioners. You can pretty well assure that you're going to have that $1,000. Now, if you're invested in the stock market, I can't have that, right? So obviously there's more to it, if you're managing a pension fund. The stuff that you have, the needs that you have for cash payments nearby, you're going to shift that from equities into bonds. And you're going to make some adjustments to that bond portfolio too as you move forward to keep the duration matched to your target date. But that's the basic idea. I also show you here one other possible alternative, and we're going to talk about an example later today. I hope we'll get to it. But another possible way of doing this, let's not use a coupon bond. Let's use a zero coupon bond. So if you look here in column B, I've got the zero with an 8-year maturity. Now that zero coupon bond guarantees me $1,000 because I don't have any reinvestment risk. I don't have any coupons to reinvest. So I don't care if interest rates go to 20% or if they fall to 2% or negative something. If I've invested in this zero coupon bond that yields 5% today, I'm going to have my $1,000 on my target date 8 years from today. So zeros are really valuable. Now, problem is that zeros are going to be a little more costly to us. So we might decide, and they're also, on a term like this, they're rather difficult to find. There's a limited supply of long-term zeros. And we can do what's called stripping a treasury bond. We can do treasury strips and use those, but those still sell at a premium because they are so useful. They're such useful instruments in situations like a pension fund where I have target dates, where I have particular payouts that I need to meet to pay my pensioners. But a zero coupon is another alternative. And of course, as we'll see momentarily, since a zero coupon has no cash flows, interim cash flows, the duration of that zero coupon is exactly equal to the maturity of that zero coupon. It's another key thing to remember. Any questions about this example here? Does that help, I hope? Clear up some of the potential puzzlement on threw me out of there. Oh, well. Okay. So that's duration. That's how we actually, the more intuitive way of calculating duration. There is, let me go back here. Yeah, we can calculate duration using a closed form solution too. And they give you a variety of them. You'll have these formulas on your formula sheet for the final exam. It's more or less plug and chug. These, by the way, these are actually designed specifically for semi-annual coupon paying bonds. That's why you'll see, YTM divided by 2. Whenever you see that, you know that formula is set up only to find the duration of a semi-annual coupon bond. And this particular formula is limited to only par value bonds. So you'll notice all we see here is YTM. We don't see coupon rate. So if your bond is not a par bond, now in an exercise in a homework problem, yeah, you can use this formula. In the real world, it's very rare that you're going to have a par bond, right? Where the coupon rate is exactly equal to the yield. So we really need to have a more versatile formula where we actually include coupon rate as well. So here we've got yield, market yield or market rate of interest, current rate, and our coupon rate as well. And again, this one is also designed for semi-annual coupons. But that'll give you the duration. I mean, rather than doing what I was just showing you before, you know, where we've got cash flow divided by 1 plus yield raised to the t over price times t. This formula gives the same result as that formula. And that is Macaulay's duration. Oops, sorry, I was in the way there. All right. One thing that we can easily do with the Macaulay's duration and is quite helpful, saves a little bit of time, is we can modify it. And hang on just 1 second. Your book actually puts parentheses around this, although it's not really necessary. And so we are taking Macaulay's duration and modifying it. How are we modifying it? We're dividing by 1 plus yield to maturity divided by 2. Again, we're assuming semi-annual coupon payments. And then that is going to give us that. So now we can use the modified duration times simply the change in yield to calculate the change in the bond price. All right. Questions so far? And again, most of the time people will use the modified duration because it just saves. If we go back to this formula, notice that if we're just using duration by itself, times the change in yield, and we're always dividing that by 1 plus YTM divided by 2. So all we've done is we've incorporated this piece of it into our measure. Now we call it modified duration. And then all we have to do is take that value times the change in yield. I already mentioned this, the zero coupon bond, because it has no interim cash flows, has a duration that is exactly equal to maturity. And again, this is a very useful device. A coupon paying bond, here's the exact definition: a weighted average of individual maturities of all the bond's separate cash flows, where the weights are proportionate to the present value of each cash flow. And there's I'll try to get this thing working so we can see it. Wolfram Alpha has a lot of neat little viewers. You can change a couple of parameters and it'll show you how that changes a graph. I couldn't get the thing to load properly on my iPad and couldn't get my my desktop to work nicely with it. But you can think of this maturity, the way that this little Wolfram viewer shows it, is suppose that we have a bunch of little beakers of water, or rather just beakers for the moment, and then each one represents a cash flow. So here we have year 1, 2, 3, 4, 5, and 6. And then what we do is so that's the actual cash flow. Notice that, you know, if it's $50, that those little beakers have the same height. And then if we take our beaker and we fill it up with water, that represents the present value of each of those cash flows. You'll notice that since the first $50 that we receive is close by, that means that this beaker is going to be more or less full. And then the next one is going to be a little less full. And then this one even less full. And so on down the line. Whereas this one is not got much in it at all because we're discounting it for 5 years. And then, of course, this cash flow still is quite full because it's a much bigger lump sum, but we're still missing a lot of that value. And so what this little idea is that if you think about this from a, you all played on a teeter-totter when you were kids, right? Think about that teeter-totter. You had a fulcrum somewhere, and you kind of balance back and forth on the teeter-totter. Well, another way to think of duration is that we're placing the fulcrum at such a point where all of these beakers exactly balance each other. It's another way to look at duration. And we'll look at that little viewer as soon as I can get the thing to function and display for you all. But because we can also change, time to maturity, we can change the coupon rates and so on, and you can see how that affects the actual duration. And that's really helpful in getting a little more intuitive feel for it. All right. I'm not going to go through these examples. They're just plug and chug. A little messy in the math, so be very careful when you work through problems on this stuff. Now, kind of back to the same set of properties that we talked about with Malkiels properties. And here we have these as it relates to duration. So, and again, it's key that we recognize we have this condition. It's also known as ceteris paribus, which just simply means all else held the same, all else equal. So when the longer a bond's maturity, the longer the duration. So with the ceteris paribus condition, that means the bond has the exact same coupon, the exact same risk, the exact same face. All we're doing is changing the duration, or excuse me, changing the maturity, and duration will lengthen. And again, all else held equal, a bond's duration increases at a decreasing rate as maturity lengthens. So as I'm lengthening out that maturity, the initial change in maturity, I see the duration shifting by a lot. But as I continue to go out to longer maturities, duration starts to slow down. And that's the cool thing about this little Wolfram viewer. Has anybody used that? They've got all kinds of relations. Alex, you've seen it? Yeah, and so whether it's math or sciences, there's a lot of finance stuff. You can build these little viewers which help demonstrate this. All else the same, again, the higher a bond's coupon, the shorter its duration. Well, yeah, that really makes sense. And this is also why I like the summation version of the formula, because, you know, when I'm summing these things up, if I've got CFT over 1 plus y raised to the t over price, to the extent that this is my coupon payment, and to the extent that that's bigger, and I'm only discounting it in the first periods for 1 or 2 or 3 years rather than 7 or 8 or 9 or 10 years, that's obviously going to become a bigger percentage of the price. So it's going to have a higher weight on that period. So that's going to mean that when I increase the coupon, I shorten duration. In other words, I'm getting my money back quicker. And again, all else held equal, the higher the yield to maturity, the shorter the duration. And again, you can go back, here's my yield, right? So that makes those coupon payments that I receive at a long point in the far out into the future less valuable. So again, it increases the percentage that I place on those nearby coupons. So again, these are some useful relations that you should commit to memory, and at some point you won't even have to think about it. It'll be right there. And here's a graph that demonstrates those properties. I'm not going to belabor that given our time frame at the moment. Any questions so far on that, though? All right. They show you a couple of different ways of, basically you just kind of have this in your head. So I might want to look at how does my price change for a particular change in yield. And a convenient change to think about is what gets termed the O1. And the O1 simply means 1 basis point. So I'm either going up or down by 1 basis point. How does that change my price? And again, I apologize. I'll fix these slides up. I thought I had already taken care of that, but obviously not. All right, so this is approximate. Come on. What's going on here? Lost my pencil. There we go. So the dollar value of an O1 is approximately minus the modified duration times the bond price times the O1. So that's, there's percentage, and this last two places are the basis points. So that 0.0001 is also 0.01% or 1 basis point. You can write it either way you want, anyway, any of those ways. I think you can pretty much ignore this 30-second. It's getting at the same thing. It's just using a different unit of measure. Think of it as, we measure in inches and feet versus the metric system. This is kind of more analogous to the metric system. I don't know, but I'm guessing that not very many people use this 30-second anymore. Because we are thinking in hundredths of a percent. We are thinking in basis points. So I wouldn't even worry about that one. I certainly won't have a question on the exam that asks you about a 30-second. You're getting the same thing here. I mean, what's a 30-second? I mean, I can figure that out in basis points, right? So anyway, that's a convenient measure to have in your head. So when you look at changes in interest rates, hey, if it's 2 bips or 2 basis points, I have an idea, okay, twice that number that I just calculated here. Let's see, and they go through an example here. I'm not going to bother with that. Now we're going to get into, and I think we've got just enough time to wrap this up because I've already kind of laid the groundwork for this idea of dedicated portfolios, duration matching, and immunization. So this dedicated portfolio, we have a particular target date that we're interested in. And we have a particular need for X amount of dollars on that target date. So we have this bond portfolio that is targeted towards that. This is typical, in a pension fund setting. And this example, I think, right here is quite helpful in thinking through that. So let's walk through this example. We've got Safety First Pension Fund estimates that it must pay benefits of $100 million in 5 years. So our target date is 5 years. Our amount of cash that we need on that date is $100 million. Now, obviously, if we pay our pensioners once a year, we're going to have a need in 1 year, 2 year, 3 year, 4 year, 5 years. So we might set up multiple portfolios for this, or maybe we have one portfolio that we can manage all of those needs. But this is just picking that 5th year. So they decide to buy coupon bonds yielding 8%. That would be nice, right, in today's interest rate environment. Of course, then we might also be facing a much higher rate of inflation, but that's a different discussion. Okay, so these coupon bonds pay semi-annual coupons. So we've got 10 coupons we're going to receive, and they mature in 5 years, and they're currently selling at par. So let's just pretend that they were just issued, and their maturity is in 5 years. If the interest rates do not change over the next 5 years, how much money does Safety First need to invest today in these coupons to have $100 million in 5 years? So we plug and chug, and we figure out they need to invest $67.556417 million today. Remember, they're going to invest that amount today, and then each coupon, every 6 months, they're going to reinvest those coupons at an assumed rate of 8%. Remember back to that spreadsheet. We're really grossing it up to 5 years out. And in fact, that spreadsheet actually has 10 periods in it, so that would be perfect for this example. You could actually plug that into that spreadsheet. I'll load that up under the resources for this set of material. So we need $67.556 million to do that. So these bonds sell for par So 67.556 million is their total face value. The face value of the coupons and those bonds then, wait a minute, with this face value, the coupon payment every 6 months is the coupon rate divided by 2 times the face value of the bonds. So every 6 months, we're getting $2.7 million. And why did I just freeze?